Hi, everyone. Welcome back to Next Move Banking. For most of modern banking, banks controlled much more of the payments relationship than they do today. They held the account, they knew the customer, they saw much of the transaction activity, and of course, they controlled many of the decisions surrounding how money moved. That relationship is beginning to fragment, and it's not fragmenting the way most people think. The bank doesn't actually lose the account, it loses the decision. I'm Virginia Heyburn, Principal Strategist with Engage FI, and this is Next Move Banking. This is the first episode in a 10-part series on payments orchestration. That's the capability that turns a payment from a transaction into an actual decision and decides how much a bank earns and keeps on every payment it touches. This will build directly on the core banking series I just completed, so go check that out if you haven't already seen it. Now consider for a second how a payment gets made today. It can begin inside an accounting platform, a fintech, or even a wallet. One company may understand what the customer is trying to do. Another may own the experience outright. A processor or a network could control important parts of how the money moves. The bank may still hold the account underneath all of it, but it's no longer the one making the decision. And it's no longer the one the customer feels they are really dealing with. And I should be clear about what I mean by the decision, because everything in this series turns on it. Inside every payment, real choices get made in the moment the money moves. Which rail it goes over, which sets the cost and the speed, of course, whether to approve it at all, the fraud, the risk call, whether to advance the funds or hold them, maybe a credit and liquidity call, what it costs the customer, and what to offer off the back of it, the next product, the reward, the advice. That bundle of choices is the decision. Whoever makes these decisions captures the value that comes with the payment. And increasingly, that's not the bank. When the customer's real relationship is with the app that they use every day, the money follows it. They leave the account open and move their balances to where their financial life now lives. So the low-cost operating deposits drain away over time. The fee on the payment goes to whoever controls it, and the data on what the customer is doing goes to whoever sees the activity. And the primacy goes, the standing to be the customer's first call when they need a new loan, a new product, any type of engagement, or even advice. That's decision disintermediation. And it doesn't show up on the balance sheet until the deposits and the loans have already gone somewhere else. This is the trajectory a bank has to refuse. Follow it to the end and the bank is relegated to one role, the holder of the deposit account. The balance sheet other companies build their business on, while they take the experience, they take the data, they take the relationship with them. There's no future in being the pipe. The whole point of the payment strategy is to keep the bank the one making the decision. My core banking series made the case that the core has become infrastructure. Competitors can buy substantially the same core, so it's no longer where a bank competes. What sets the bank apart now sits above the core in the intelligence layer, where the bank makes sense of everything it knows about a customer. Now, modernizing the core and building the intelligence layer were never the goal. They were the groundwork. You do that work so the bank can finally act on what it knows. It runs both ways. On one side, there's new value for the customer that a fragmented, hard-coded stack could never support. And on the other, real cost is taken out because catching fraud in the moment prevents the loss instead of cleaning it up. And one interoperable system is far cheaper to run than a dozen silos held together by hand. That's what this series is about. Because knowing something is not the same as acting on it. Orchestration is where the bank acts. It reads what's happening in the moment. It weighs it against everything the bank knows about the customer, and it makes the call on the payment in real time. Then the infrastructure moves the money. Of course, AI is foundational to all of this. No topic on bank technology is complete without AI, but also none of what I'm describing happens at scale without AI making the real-time decisions a human never could across every option in the moment the money moves. But AI is not the whole answer. It does get oversold. A bank with fragmented data, no clear sense of its own risk appetite, and no control over its execution does not become orchestrated just because it adds AI. What AI does is make the hard part finally possible, which is why orchestration has been talked about for so many years and it's rarely been built. And the timing is the whole point. The banks that build this now will make these decisions on their own customers first before any company starts making those decisions for them. And payments is the hardest test of all of it. Every payment is two things at once. It's the richest, most current signal a bank gets about a customer, how money is moving, how cash flow is changing, who they pay, what they may need next. And it's also a demand for action in real time with no time to deliberate because several parts of the bank have to respond to the same payment at the same moment. And that's where the trouble starts because those parts were built and run separately on different technology by different teams, often bought from different vendors. The core, the data platform, the digital channels, they're all separate systems. Payments, fraud, lending, treasury, those are separate groups. So the one event the customer experiences as a single payment lands inside the bank as 5 or 6 disconnected events. That fragmentation is expensive to run. It leaks revenue through manual work and exceptions, and the customer feels it directly because the payment might take up to 3 days. Maybe the card is declined for no reason. The funds held longer than they should be. What a bank cannot do in payments tells you where its modernization stopped. Payments is where your technology strategy falls down. There's also a second type of fragmentation, and it sits inside the bank. A bank does not offer payments. It offers ACH, wires, cards, real-time payments, checks, bill pay, and now stablecoins. Each grew up in its own silo, on its own system, run by its own team with its own pricing and its own risk and settlement. They were never one thing. The customer feels it as different limits, different timing, different screens, and no single view of money in and money out. The bank feels it as a blind spot because no one system sees the customer's full money movement. This is the enterprise payment strategy banks have talked about for decades and never reached. The stack was never unified. A commodity core, an intelligence layer that sees the whole customer, and now orchestration across every payment type is what finally lets a bank run all of its payments as one system, giving the bank a single view of how the customer moves money and the customer a single coherent experience of the bank. It's also what lets the bank absorb what comes next. Think stablecoins, tokenized deposits. They're not just new rails, they're new forms of value, and the difference matters. A tokenized deposit is still a deposit on the bank's balance sheet. A stablecoin is someone else's liability entirely. A bank with real orchestration can fold both into the same system on its own terms instead of standing up another silo or ceding them to someone else. For a community bank, the payments relationship is usually the whole relationship. The operating account and the everyday movement of money are what make you the primary bank. That's where the deposits sit, where you see how the customer is really doing and where the daily engagement happens. And the lending and the advice and everything else follow from that. A large bank that loses this is giving up margin it can afford to lose. A community bank that loses it is giving up the franchise. And it's worse than a clean loss because once a customer runs their day-to-day money through someone else's platform, whether that is a business or an accounting system or a consumer in a wallet, the switching cost stops protecting the bank and it starts protecting the platform. Across the next 9 episodes, I want to bring you what a community bank will have to do, not to get ahead, but to compete and survive. 9 capabilities in payments, 1 per episode. And they fall roughly into 3 groups. The first is the payment decisions that you control. You make every payment decision yourself instead of taking your processor's default. You act on money the instant it moves so a customer can use funds the hour they arrive. And you catch fraud inside the payment before the money is gone, not after. The second area is the customers you keep. You hold on to the customer even when the payment starts inside someone else's platform. You reward and you price the entire relationship instead of one product at a time. Why? To drive the loyalty and the primacy that keep the customer yours. And because the payment activity shows you how the customer is really doing. You can see what they need before they ask, and you can be there first. The third area is the deposits and funding you hold on to. You keep the pieces of the payment that actually pay you as more of it gets taken over by other companies. You see deposits and funding start to move before they even leave the bank, while you can still do something about it. And in the end, you own the decisions that set what you earn and keep, rather than depend on a company that does. Those 9 capabilities are what this series is about. And across these capabilities, I will show you where a community bank is losing control today what it takes to hold on to the franchise. Because in the end, the choice is this. The bank makes the decisions inside its payments, or it hands them away, one at a time until the relationship is someone else's. And this is the kind of work we do at Engage FI. We sit across the entire stack. We're not tied to any core, any rail, any platform. So the only interest we bring to these decisions is yours. Next episode, we start with orchestration itself and why it means far more than routing a payment to the cheapest rail. Every payment is a decision. Who's making yours? I'm Virginia Heyburn, and that's your next move.